This video is called The Stock Market Apocalypse Just Started. This is bad.
Meltdown right now. It's getting worse by the minute. The S&P 500 is down 7% over the past month. The Nasdaq is actually even worse at 11%. Stocks like Palantir and Tesla are down 32%. Nvidia is down 20%. And a lot of questions from subscribers, from Academy members, from random people on the street. What's going on, Tom? Is this the end of the bull market? What should we do? Etc., etc., etc. I totally understand all the questions. I get it. I understand the panic, the anxiety. I totally understand. But for me to explain A, what's going on, B, what comes next, and C, what's the best strategy, not just to survive this, but actually use this to make money, I gotta start with history. If you want to know where you're headed, you have to know where you came from. History is key in understanding what happens next. So over the past 9 decades, that's 93 years to be exact, we had a total of 50 market declines of 10% or more, much like the one we're having right now. In fact, if you do some math, statistically, it means that every 2 years, every couple years, this happens. Now, this means that...
And to his point, this is why you need to always trade risk first. Always trade risk first. Because you don't know, I don't know, you don't know when these corrections happen, right? We can read on the charts, and you've learned a lot about that in the last few weeks, haven't you? We can read on the charts, but at the same time, we need to be respectful of that risk, because that risk can come and take out years worth of gains. This morning, we talked about how the market doesn't always go back up. Even though so many people on the internet say, buy the dip, it always goes back up. The dip for 2022, it took like a year and a half to make up. The dip from the NASDAQ in 2000 took 17 years to make up. Only Nancy Pelosi has the right-hand side of the chart available. Only she has that plan. Now, until they make that plan less than $84 million a year, we don't know what that's going to look like. So we have to respect the risk and always trade risk first. And risk first means I'm not going to tell the profit. I'm not going to tell the stock how much profit I want to make. But I know for damn sure how much risk I'm willing to take whenever I get into any stock.
Market corrections like this are quite common and nothing to get emotional about. Now, even further than that, 25% drops, what you call a bear market, those happen a lot more often than people realize. Over the past 93 years, we had 15 25% drops or more. That means every 6 years, we have a bear market. Every 2 years, a 10% decline. Every 6 years, a 25% decline. Not that uncommon. And it's very easy to forget these stats. It's very easy to forget this history. When times are good and everybody's making money hand over fist, everybody's celebrating a 60% return over 2 years from the S&P 500, it's easy to forget it. And that's why so many retail...
That's the thing, right? The last 2 years, 20% each year. And people think, oh, it always goes up. They forgot about risk. They forgot about what happened in 2022. The market literally peaked on the last day of 2021 and went down 10 months in 2022. Yet the market always goes up. Right? And so they've forgotten about how hard it hurt, how much it hurt when they were buying those dips on the way down, because they can only see with rose-colored glasses. Oh, because I bought on the way down and it came back up, I'm a genius. Well, what if it doesn't come back up that fast? Right? What if it takes you 6 years? What if it takes you 17 years, like on the NASDAQ? So history has shown this can happen. Are you cool with being down for 17 years? I know I'm not.
Investors and traders are surprised and shocked when this happens. They don't expect it. They don't understand that it's coming for them every 2 years, every 6 years. And that's why when they look at the hysteria in the street, at the headlines and social media, they're all put in the spin cycle. And eventually they make stupid decisions. Now, if you watch this video, I guarantee you that's not going to happen to you. Let me show you how. Every single person that watches this video will agree with me, I'm sure.
All right. Well, I'm doing my part to spread the message. Let's go, Tom.
That on average, the S&P 500 gives you 8 to 10% per year. And in fact, we can all agree that on average, long term, the S&P 500 makes money. It doesn't lose money if you stay in 10, 15, 20 years. It's impossible.
This is facts. Hang on. He better not say it's impossible.
Possible to lose money in the...
Okay, never mind. Just because it has gone up doesn't mean it will continue. And will it continue? Very likely. But it might take a long time for that to come back. So please don't say it's impossible.
the S&P 500 sitting there for 20 years. It's never going to happen. And yet we can also look at the statistics, and what you will find is that 90% of retail investors and traders lose money. Even though the stock market keeps going up every single year, it has a bad year, it has a good year, but on average, it keeps going up. When you zoom out, it's clear, and somehow only 10% of retail investors make money. Why? Well, that is because, number one, they're not mentally prepared for this. Whatever that we have going on right now, for however long this lasts, they're not ready for this. I just mentioned it a second ago. A lot of you know this because you watch my videos, and I've been saying this for years. If you cannot handle a 30 to 50% drop in your portfolio, do not be a long-term investor. It's just going to crush you. Now, good investors, they don't just survive this. Good investors are going to use whatever's going on right now to make a lot of money. They use this to make generational wealth happen. And I'm showing you in this video exactly how to do it. A to B to C, everything you're going to see in this video, step by step, how good investors use these sort of crashes to make a lot of money. And there's way more to this than just DCA. So relax, pump the brakes on this one. Now, let me ask you a question. If you like a stock like Palantir at $120, are you not ecstatic to get it at $80? What changed in the case of Palantir?
Oh, I hate it when people do that. I can't wait for Tom and I to have a nice chat every morning. Right. If you love it at $100, or you'd love it at 120, let's just circle a couple spots on the chart here. If you loved it at 120, wouldn't you be so excited to buy it again at 80? I mean, imagine you're buying a jacket, right? You got a cool new black jacket you want to put on today, and you go to the jacket store and you're like, excuse me, Mr. Jacket Salesman, how much is that jacket? And he's like, well, actually, this jacket is $120. And you're like, okay, that's outside my price range. Let me come back. So you go to Target, go to GameStop, you do all this stuff, you know, a couple weeks later, you come back and you're like, excuse me, sir, how much is that jacket? I saw that y'all were having a sale. And he's like, well, actually, you're very lucky. This jacket used to be $120 by Thurston Howell III. That's the brand inside here, Thurston Howell III. It's actually only $80 today. And you're like, yes, let's do this. Let's do this, right? I get that. I get that. But that's not the same with assets. That's not the same with assets. What this is more like is if you're buying a house in a nice neighborhood, right? They just put a Texas Roadhouse in, they're building a Home Depot, there's a Starbucks going up on the corner, new schools are going in, everybody's super stoked, right? All of this is beautiful, new landscaping. Oh man. And then a big gap up because there's a new company moving into town. This is awesome. And that's why the price has gone up so much, because people are excited to be into this. People are excited to be into this. But then a few years go by and the Home Depot had to close. The last Walgreens in town just had to close because they had everything behind locked cabinets. And it's starting to look like San Francisco around here. And you got people hanging out on the street. And rather than idyllic, scenic, beautiful suburban Texas like I live, we're in a situation where this is heading towards Philadelphia, or this is headed towards San Francisco. And there's a crack house who just popped up on the corner. That's the situation we're in here. Do you see how it's different between like a disposable, something that you want to get on sale, versus an asset that you actually want to own and keep? If it's going down like this is the market telling you it doesn't like the stock. Now, this can be a great opportunity to buy. This can be a great price to buy on the other side of the dip, right? If you love it at 80, waiting until all the crack houses have moved out, the governor has come in and he's like, all right, we're fixing this. Yes, we let things get a little bit too far. We're going to clean it up real quick. And then it starts going back up. That $80 price right there could be the best deal ever. Do we see how this works? Right? You can still buy it at 80, but buying it at 80 on the way back up versus buying at 80 on the way down, and we don't know how far down it's going to go. So if $80 is the price that you love it at, why not hang out? And it doesn't matter if you're a long-term investor or a short-term trader. The deal is to make money. And if you're buying it on the way down, we don't know how far down it's going to go. So let it tell you where the dip is going to be when it stops dipping.
Palantir or a Tesla or an Nvidia before the drop and after the drop? Except the price that obviously dropped, did anything fundamentally change about the company? Well, the answer is no. And if you truly understand this, and if you truly embrace this concept, if you are really a long-term investor, this dip is exciting. It's nothing to be scared about. In fact, most of my community is excited about this dip. They're praying for Palantir at 60, 50, 40 because they understand the opportunity. And that is exactly my next point.
And it can be a great opportunity. Let me jump into all this. Buying it at 60, 30, 40, whatever, can be a great opportunity. It can be a fantastic opportunity on this side of the curve and not on that side of the curve. Come on, because we don't know how far down this goes. We have no idea how far down this goes. If it actually got to 30 and you're still holding it and you bought it at 120, you're playing the wrong game. Sorry, go play Mario because you ain't meant to be in the stock market. If you are a long-term holder and you are so happy that your stock is down, let's just, because he said this, not me. You're so happy that it's down at $40 and you're down 66% on your investment, you're in the wrong game. You're not playing it right. Sorry. And don't give me this malarkey. Don't give me this hogwash about I'm a long-term investor. I don't care if it goes down. Shut up. Yes, you do. Shut up. Yes, you do. You actually think you're going to bed at night. You're like, I'm so happy. My investments are down 66%. I'm a genius. Right? No. No. And don't also give me this malarkey about how you don't want to sell because of taxes, right? Somebody left a really great comment, and it was selling because you don't want to pay taxes. It's like asking for a raise at work, and then when they give it to you, you're like, nah, you know what? I'd have to pay more taxes, even though I'd make more money. I don't want it. Never mind. Okay. I hope this video gets better.
Point. Bad investors tend to confuse volatility and risk. Good investors understand that volatility is not risk. It's an opportunity, and it's an opportunity to make a lot of money. Now, remember all the people who were cracking jokes at my expense when I was buying Palantir at 10, 8, $6 back in 2022, saying I'm an idiot? Well, where are those people now? Even now, yes, today, after the huge drop in Palantir, we're still at $80 per share. Maybe tomorrow we're going to be at $70 per share. Maybe in a week we're going to be at $60 per share. That's still 10x from the moment they made fun of me just a couple of years ago. And that is just one example of that. If you truly are a long-term investor, you're going to use this discount and many more to follow to make money over the next 3 to 5 to 10 years. Because if you invest in a good company during a downturn, because the stock price dropped over macro concerns, eventually you're going to make money. But the problem is that most people are not going to use this system. Most people want quick results. This thing takes 3, 5, 10 years to materialize. It's the same people who go to the gym expecting results in 6 months and then they never go back again. The same people who want everything quick. This ain't quick. It's never going to happen quick. If you're not ready to accept that, if you want quick profits, go trade, go gamble, go to the casino. I don't care. But this thing is exactly what Warren Buffett was talking about. Everybody wants to get rich. Nobody is willing to get rich slow. It's that easy. It's very easy to become rich from the stock.
Bro, you're not getting rich if your investment's down 66%. If you're holding it and it goes down 66%, you're not getting rich. You're getting kicked out of bed by your wife, right? You're getting foreclosed on. You're getting into a completely different lifestyle than you would have had if your investment was still up. Now, how would you know? How would you know? Well, first off, let's do a couple exercises here. I think that's a good question. How would you know when to get out? First, what's your trading plan? I don't know your trading plan. What's your trading plan? It sounds like for people like Tom, the trading plan is to buy anytime. I would encourage people, if you don't have a trading plan, to start studying the market cycle, right? You've probably seen this before, but the market cycle is stage 1 is in the yellow boxes, right? Stage 1 is where it's neither going up nor down. Moving averages are crossing back and forth, right? Stage 2 is when these moving averages spread apart. And this is the exciting part. This is the optimism, belief, and thrill, right? That did happen in Palantir. Tom did make money in Palantir on the way up. This is stage 2 right here. Yeah, it's awesome. Stage 2 rocks. But not every stock is always in stage 2. because then you have stage 3. This is where the moving averages start crossing around. And specifically exactly what you see right here happened. And then stage 4 is the red area, the anxiety, the denial, the panic, the capitulation. That's where people are in a lot of stocks right now, anxiety, denial, and panic. And they're like, what am I supposed to do? Am I supposed to buy more? And then what happens is they come down here and they're back in stage 1. You want a really recent example of this? Let's look at our old friend Tesla. This isn't theory. This is reality. Our friend Tesla went up 120% and then back down 100% of that. Isn't it crazy? But if you love Tesla at 225, it could be a great price to get back in because you love the company and think it's going to go up forever and ever and ever. But just wait until the upping starts going upping, right? So if you're a long-term investor, I would say follow one moving average, just one moving average. It could be, in fact, let's do this on Palantir. Let's do this exercise on Palantir. You could follow the 50 period moving average right here. You could follow the 20 period moving average. That's the black line right there. You could follow the 10 moving average. So the 10 means you'd have to trade a lot more. The 50 means you'd have to trade a lot less. Or you could even back this out to the weekly charts. Do the same thing there. Maybe you follow a 10-week moving average, right? We know we're never going to catch the top or catch the bottom, but you don't have to go all the way back down. Oh my gosh. It's like a bouncing ball right there. You don't have to go all the way back down like Tesla did. And Tesla is something he is ultra bullish on. Ultra bullish on.
Market slowly over 3, 5, 10 years. Now let me ask you a question. How many of you like Taco Bell? Now, I'm not asking because I'm hungry. That's besides the point. I'm hungry, but that's not the point of this video. I mean, Taco Bell is a huge chain. I mean, it's a household name, right? So back in the day, way back when in 1972, Peter Lynch, one of the best investors of all time, one of my own particular goats. I absolutely love this guy. Peter Lynch in 1972 was looking at Taco Bell. And basically what he saw is that the share price was dropping from 14 to 13 to 12 to 10 to 8 to 7. Now at $7, he said, look, it's a good business. There's no debt. The fundamentals are phenomenal. No store closures over the past few years. The price just dropped by half. I'm going to buy this stock. And he started buying heavy at $7 per share. Now what happened next is absolute insanity because this was not the bottom. The bottom was at $1. He kept on dropping from 6 to 5 to 4 to 3 to 2 and eventually to $1. He bought it at 7 and he ended up with $1 per share. A huge dip, but he kept on buying for the same logic. Good business, no debt, no.
That's so dumb. I'm sorry. But if you thank you for illustrating my point, Tom. Thank you for specifically exactly illustrating my point. Let's imagine, let's do this. Let's imagine that this is Taco Bell. Right. I know this is a Yum Brands now, but maybe in the 70s this was Taco Bell. Hang on. I was starting to write Yum. Let's go Taco Bell. TB. Now, I don't mind a little Taco Bell. I love a cheesy gordita crunch. One of my favorites there. My son loves the Dorito tacos. Funny story. One time I went through Taco Bell and I was like, I need a couple things, a couple tacos, couple burritos, whatever. And they rang me up for 99 tacos. I looked at the price and I was like, $514. I was like, wait a minute. Something's not right on this. I don't want 99 tacos. And he's like, oh, my bad. But here's the deal. Imagine Taco Bell was at, we'll use some rounded numbers here. We'll say it's 10. And Peter Lynch found it at 7, right? And he's like, oh, now's the time to get in. So he bought it at the 7 candle. And it went all the way down to 1. And let's say it bottomed at $1. Here's the crazy. You're not going to believe this. You're not going to believe this. It actually went back up. And hear me out. He still could have got it for $7. Still could have got it for $7. He could have looked at it and he said, you know what? 7 clearly on its way down. On its way down, 7 may not be the best price. What about 5? He could have got it for $5. What about $3.50? $3.50 here. Could have got it for $3.50 when it goes back up. But I guess I guess, in the infinite wisdom, which is a stock isn't going to go to zero, that it was worth losing. What is 6 divided by 7? It was worth losing 85% of your investment. It was worth losing 85% of your client's money to find out if it was going to bottom and go back up. And then, let's say you still loved it after it farted around on $1 for a hot minute and started to come back up. You're like, here we go. All right, $3.50, $5. He could still buy all these shares, $7. He could still buy 1,000 shares here, 1,000 shares here, 1,000 shares here on the way back up. And you're not going to believe this. You won't believe this. The dollar cost averaging, same. Let me get a little closer for that. The dollar cost averaging would be the same if he bought it on the way up or on the way down. It's a crazy idea. Crazy idea.
No closures. This is going to recover. Now, a lot of you don't remember 1972, but some of you may. Don't cheat. How many of you can guess right now in the comments without Googling how much he sold this thing for? I'm going to give you 5 seconds. 1, 2, 3, 4, 5. I cheated a little bit there. $42 per share. Peter Lynch sold this thing for $42.
And, oh man, I deleted my thing. And so he sold it at 42 a share from $1 all the way up to 42. Guess what stage that probably was in? Put in the chat. You guess which stage it was probably in. Once it went all the way down from stage 4, and then it hit stage 1, and then it started to go back up. It was in stage what? Put it in the chat. It was not stage 4. It was stage 2. That's right. Stage 2. Stage 1's down here. Stage 2 is the left-hand side, the exciting side. Stage 3 is the top. Stage 4 is the declining side. Yeah. He wasn't buying it. Well, let me rephrase that. By buying it on the way down, he caused additional stress. And like Mahesh, thank you, Mahesh, for jumping in. Mahesh is our CEO. Mahesh said, what if you sell everything at one because you can't take the losses anymore? That's like how the human brain works. Losses have way more effect than profit. Yeah, no joke. Losses impact you exponentially, and profits are linear. That's not just how they feel mentally, right? Peter Lynch was down 85% on the trade. Here's a crazy stat. If you're down 90%, you need a 900% gain to get back to break even. So he needed the stock to go up 900% from $1 back to 7, give or take. I'm rounding, of course. What? But like I say, the dollar cost averaging at 5, at 3.50, at $1 was the same going up or going down. The choice is yours. The choice is yours. My itty bitty baby brain doesn't comprehend why anybody would buy something on its way down, because you can still get in when it's going back up and your average cost would still be exactly the same. Please enlighten me in the chat or on the replay in the comments. Please enlighten me. It was a 7. Stage 7.
$2 per share. All the way from 7 down to 1. DCA'd all the way. Sold this for 42x from the bottom. Now, this is one example from 1972. We had one just in 2022. Palantir went from 35 to 6. A lot of people bailed. I kept on buying. Palantir investors, OGs, a lot of them are on X, a lot of them are on YouTube. A lot of Palantir OGs kept on buying. I was not the only one. We all kept buying. Stock goes all the way to 125. From 6 to 125. That's a 1,300% climb. And now it's back down to 80. And again, the panic starts, the hysteria starts, all the negative talk starts. We love this. We love this because this is another opportunity before the next spike. Because the company has no debt. It's a great business. It's going to go up, and the price is not dropping because of anything. It has to do with Palantir. It's just a macro crash, or a correction. Sorry. We don't still call it a crash. We'll see what happens next. But here's the thing. Short-term fear equals a buying opportunity if the company is good. Now, look, if you look at a good business, if you look at a company with strong fundamentals, then if you mix these ingredients with volatility, you get money. This is a money printing machine. Now, it doesn't work if you don't have conviction, because holding from 7 all the way to 1 what Peter Lynch did, holding from 35 all the way down to.
Oh, I disagree. I think that's the conviction's the last thing you need to have in the market. Conviction in the market will lead you to take unnecessary risks that you don't need to take. Right? And that's why I have this slide on purpose. This is trader psychology in a nutshell. Have no expectations, meaning have no conviction in the trade. I don't care what happens. I know you're probably thinking, Chris, how can you think that way? How can you not care what happens? Don't you want to win? Look, I've been there. I understand where you're coming from. But imagine by having no conviction in the outcome, I don't know what's going to happen. I could make so much money, or I could make a little bit of money, or I could break even, or I could have a small loss. Big losses are off the table. I'll never take an 85% loss. No, sir. I don't have any profit targets. Kind of like Peter Lynch didn't have any profit targets either. He just let it go. Sounds like the lazy way to invest is just buy something on the way down and have conviction that it's going to come back up. That's not the way it's done. I'm sorry. That is absolutely not the way it's done, because you're going to get caught in a situation. You're going to get caught in a situation like this. And a lot of people are feeling all these emotions.
To 6 with Palantir is what we done. That requires conviction. That requires understanding the company and understanding that nothing changed about the fundamentals despite the price dropping heavily. And that's not an easy thing to do. And that's why a lot of investors sold out of Palantir in 2022. That's why the Taco Bell thing worked. That's why all this action in the short term is basically just a voting machine about sentiment, about fear, about greed, all these emotions, nothing to do with fundamentals. Now, I'm going to be honest with you here. And
who gives a crap about fundamentals? I got to use it. Hang on. Who gives a crap about fundamentals? Only price pays. Oh, it's been a hot minute since I got to pull that out. Since I got to put out who gives a crap about fundamentals, right? Because these people, they're excited to buy. When these people are so stoked to buy, that is what causes these kind of moves. Fundamentals do not cause that. Can fundamentals help with that? For sure. But it's all the emotions that go along with this. All the emotions that go along with this.
I want you to pay attention very, very carefully. Buying the dip is not always the smart thing to do. Buying the dip is not always the right way to go about this. Let me explain. The biggest misunderstanding from new investors, which I want you to avoid, is that buying the dip just because a company's share price went down, that is not an investing strategy. Just because the stock dropped.
I feel like he's talking out both sides of his mouth.
Up doesn't mean you should be buying the dip. Because a lot of people say, well, how lower can it go, man? It already dropped so much. It can go down a lot longer, a lot lower.
Wait, what? He's saying the exact opposite that I did 10 minutes ago.
There's no way you can time this. Now, I'm going to give you an example going back to way back when. You remember Polaroid? Well, that company was trading for $130 per share. Then it dropped to $80. A lot of hype about it. Well, if it drops down to 80, we got to buy this. This is a buying opportunity, blah, blah, blah. Nobody talks about the business. Nobody talks about why Polaroid was getting disrupted, why the fundamentals were deteriorating, why the company was going to the toilet. They were all looking at one thing, is the price, only the price. And then what ended up happening?
Tom knows. Tom, we've had this conversation. Tom knows. He watches us. Tom knows. That only price pays. Yes, I'm so excited to pull this out so much today. Because that's all that matters. If you're an investor, who gives a shit about the fundamentals? Who cares about their PE ratio or their EBITDA or their whatever? Who cares? Name. Okay, in the chat, type in your most watched fundamental. Go ahead and type it in. Type in your most watched fundamental. It doesn't matter. It doesn't matter, because the price at the end of the day is the only thing that will go into your bank account. Oh, you know what? You guys got real clever on this. This is the fundamental you should be watching. I like this. Salty Nate, or Salty Brad and Nate right there. I like this. Maybe that should be a fundamental. The outlier trend template. The 10 over the 20, price over the 50. Maybe that should be. I like that. Because if you don't follow this, what's going to happen? Your fundamental is about to be monkey hammered. That's what's about to happen.
All these people pile in, and the company went bankrupt, eventually going down the drain. All this money lost. Buying simply because the price dropped without understanding the fundamentals is not an investing strategy. Forget about it. Instead, figure out two things. Number one, is the drop justified vis-a-vis the fundamentals of the company? And number two, does this drop even have anything to do with the company, or it's the entire market just basically diving off a cliff and this company going along for the ride? If the answer is yes to either of those questions, if it's company specific but not justified, or if it's not company specific, in this case, dollar cost average into this on the way down slowly. Slowly, because you don't know where the bottom is. Remember the Taco Bell example, from 7 all the way down to 1. He thought 7 was the bottom. It wasn't. Now, it all comes back to one simple principle, which is know what you own. If you know what you own, this becomes super easy. If you don't, huge drops, panic, and noise from mainstream media, from social media, it's gonna cause massive panic, massive emotional paralysis, and a lot of you are gonna sell out, not understanding what you're doing. And that's how 90% of investors, retail investors, lose money in a market that only goes up long term. You see, good investors, they understand volatility. They understand what it is. They are not confusing that with risk, and that's fine and dandy. But
and we'll go ahead and end it here. But I absolutely agree with him. Knowing and understanding volatility actually is a great thing. Like, volatility is actually phenomenal. Why is volatility phenomenal? Because it takes volatility to get from stage 1, where nothing's really going on, into stage 2. This is volatility. Sounds crazy, but this is volatility. And then when the volatility contracts, this is stage 3. These are when your moving averages are crossing over. Even on the outlier trend template, that Rye NY fishing can't stand me with my outlier trend template because I'm so right. Even though he can't stand it, it's only the truth. And then the volatility comes back on the other side. So here's the deal. Volatility is great if you are using it correctly. If you're trading with the outlier trend template, that'll show you the volatility. And I'll show you an example around here, right? In fact, this is really cool. So down at the bottom, I have what's called the ATR indicator. This is the average true range, and this measures volatility. And this is on Tesla. You can see Tesla had pretty low volatility back in early 2024, and then it picked up. What happened? Volatility expanded. Let me reiterate my point here. This is on weekly candles, by the way. The volatility expanded, and you can see just how big these moves got. That's a great thing. Volatility is great if it's moving in your direction with this outlier trend template that Rye NY fishing cannot stand. But that's okay. That's okay. I'll just be right. And so will all the other outliers. But I'm glad you're here. Hey, let me introduce myself, Rye. You may not know who I am. My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time, and I got receipts. It's over on my YouTube channel. Go over to the playlist and you can watch some of the interviews I did with them. Pretty amazing. I love those guys. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk. So if that sounds good to you, you're in the right place. And we do this together as a team. Now, I want you to rank this video of Tom's. I think we all know where we're going to rank this video real quick. I think Tom knows exactly where we want to rank this video, but go ahead and subscribe if you haven't done so already, Rye. Let's do this. Oh, this is last week. Hang on here. Hang on here. Hang on here. Hang on here. Let me get the other ones. Where are you ranking this video here? I know what Tom would want to rank us at, or rank himself at, I should say. Tom would want to rank himself at a big old fat number 2. Tom would want to be a 2 because Tom's funny like that. I like Tom. So let me get a screen cap of this real quick, and you guys put it in the chat where you'd rank it. I want to hear where you'd rank it. That's what I think. I would say this is very, yeah, actually, I'm going to rank it at 3 because it's frustrating. Because half of the video, he talked about how great it is to buy a stock on the way down. Then the other half of the video, he said, you need to make sure you don't buy stocks on the way down. You need to have conviction, right? Did I mishear him or something? So yeah, for me, I'm going to put it as a number 3. A little frustrating for me. But that's okay. That's okay. My friend Tom would be totally cool with that. But you know what? I also want to showcase one of our friends over in the Discord in today's member highlight. So we're going to go over into the share your big win section here. And let me scroll up just a smidge. Oh, this is something I would really like you guys to do, if you don't mind. Mahesh put out a post asking if you all would mind leaving a Google review for Outlier. If you don't mind, please doing that. You can be honest with your review. We'd really like to do that. But that would be a huge help for us if you could leave a Google review. But there was one, Albertone. Albertone, I don't know if you're watching live, but I hope you are. I'm really glad that you're here. Very analytical thinking by Albertone. He has a lot of really good posts. And this one here, when should we start looking for shorts versus longs? Is the signal breadth the red circle crossing over here? Or should we wait for the green candles in the yellow circle to get bigger than the reds? Now, let's talk about what this is. So this is the market breadth inside of Outlier. And inside of Outlier, scroll over here. What he's talking about is this crossover point here. So the green line measures how many buy signals versus sell signals that we have right now. And you can see on January 27th, the receipts are out there. I said we're looking for a pullback because market breadth had peaked. What happened? Exactly what I expected. Now, this has come down and it's flattened. And I was just saying earlier this morning, I would be looking for more of a short covering scenario where people who have made money on their shorts will be looking to close their trades. We might be looking at a temporary bottom in the market. We might be. I could be wrong, right? I could totally be wrong. But we do see the market bouncing right off this order block right here around the same time as market breadth seems to have been crashing bullishly. So let's also dissect real quick. What do I mean by short covering? There was one this morning that I pulled up. That was a perfect example. Let me see if I can find it in my recents real quick. The WPM? No. Was it PGR? No. Dang it. Sorry. I don't have it handy. But I believe it was one of these. Let me see if this is it. No, that wasn't it. 2 seconds here. I'm going to find it. I'm going to find one that's good enough for my example here. Just a second. You can see the buy list, the bull list has 29 new today versus the bear list having 20. So we're getting more of these buy signals. Yeah, here we go. Perfect example. This is what I think is causing the market breadth to turn. Is imagine if you went short here, now you're covering your short position on this side. And that's why it would have a buy signal. All the stocks that we cover either have a buy or a sell. There's no in-between point. So if we sold here and then bought back here, that would cause the market breadth to go back up. So good point out there by Albertone. And then his second question is this right here, the overlays. So what this measures is how many stocks are in a green or a red overlay. How many stocks are in a bearish trend or a bullish trend? And you can see here, the weighting of that is really skewed on the downside, isn't it? How many stocks do you see in this comparison right here? Right, I would say it's probably 5 times as many in a downtrend versus an uptrend. And that is measured on the background, right? The red background is associated with this red value right here. The green background is, as you would imagine, the green background right there. So to his point, where do we look for new opportunities? So I would say first, keep this in mind. This is a really easy rule of thumb. In fact, I'm going to do this. I'm going to type it out as a banner and I'm going to pop it up when I feel like it. 40% of the stocks move is due to the market. And then plus 30% of the stock moves due to the sector. And then plus 30% is due to the stock itself. So I'm going to save that and pull it up right there. So 40% of the stock's move is due to the market, 30% is due to the sector, and 30% is due to the stock itself. So in a situation like PGR, well, you can't see that, sorry. In a situation like PGR, right, this could be even better if the market and the sector were also performing well. Because this move on its own is great. But just imagine how much greater, how huge this market could be. It could be tremendous. It would be enormous. it would be the best move of all time if it had more more rocket fuel behind it, I guess you could say. So let me catch up on the chat here. Tom deserves an 8 every once in a while. I agree, but that was not the video for that. It was a contradicting video. Yeah, Mr. Baggins, I see what you did there. He's right about one thing. Perma bulls beat perma bears. I mean, can we all agree to that? Yeah. And that's why, as a trader, you shouldn't be perma anything. You should be perma, I'm looking for opportunities. You should be perma, I'm going to take all the trades that come my way. That's how I feel. Mira says, I'm just wondering, why do you do your videos at the start and end of the market? Well, A, because it's convenient for me at the beginning of the day, and B, because I like to trade in the last hour of the day. I know for sure I'm not going to have any trades right now, which is why I'm not like freaking out that we got to get to trading. But the last hour of the day is when the most liquidity comes through. So that is why I trade at the end of the day. Steven says he's learning from you. Iron sharpens iron. Eset says, delete it, Tom. Delete it. Okay. So that was the member highlight that I wanted to show. I wanted to show you Albertone. I think he's really being smart about how he's looking at the market right now, because Outlier has a ton of data. A ton of data is inside of Outlier, and learning how to read that data is for sure one of the best things that you could do for your entire life. For your entire life is learning that. So be sure to share your stories in the Discord. And of course, the first rule of Outlier and the way that you can pay me back, the way that you can pay me back, if I've helped you in any way, is to tell everyone you know about Outlier. That's all I ask, is if you find somebody who needs to learn how to trade stocks and you've been successful and you've learned how to trade something, do me a favor and just tell them about Outlier. That's what I'm looking for. And of course, hit the like button. Now let's get back to trading in the Outlier trading room. So real quick, what is Outlier? What is Outlier and what does it do? Well, Uncle Warren would say, be fearful when others are greedy and greedy when others are fearful. An Outlier shows you if investors are acting irrationally fearful or greedy and by how much, allowing you to get into the market or get into the stock, as I trip over my words, before the Outlier move happens. And don't forget, you can get into the Outlier annual pass for just 82 cents a day. That's 64% off the monthly price. And if you're in your trial right now, go ahead, shoot us an email and we'll be glad to update you. No stress. Now, my style of trading using Outlier is called the golden ticket trading strategy. And this is where only price pays. And it starts with the market, the 10 under the 20, price under the 50 if I'm bearish. So if I go over here to SPI, continues to go down 75 basis points right now. So this is absolutely a bearish trend. Now, you're not going to believe this. The Outlier trend template will tell you which direction it's going, with the 10 under the 20, price under the 50. It can go both directions, absolutely. And there will be times where it goes over and under, and you might lose a buck or you might make a buck, but it'll keep you on the right side of the trend and let the market tell you which direction it's going. Now, market breadth, we just talked about how it's actually crossed bullishly, which locks me out of the master key. The SPY still has a sell signal. The market trend is still bearish. Market breadth has turned bullish right now. So the master key has locked me out, and that's okay. I have no FOMO. You will find no FOMO on this side of the camera. I'll put it to you that way. But I do want to take a look at some of your stocks. So put your stocks in the chat. No trade setup for me today, but let's take a look at what you're looking at. Like Inkari wants to look at XPEV, XPEV, and we may not cover XPEV. We cover 2,500 stocks, and for those that we don't cover, we don't have enough data on them just yet. So XPEV is one we don't have enough data on, but I will look at it on the chart for you real quick. I'm gonna try to look at it for you on the chart real quick. I don't know, it's going really slow. There we go. Okay, beautiful, beautiful move. And you can see right here, gapped right over that order block, like it wasn't even there. I would ask you, Inkari, is what is your exit strategy? My exit strategy in this case would be to sell as it gets to earnings, because this is one of my all-time favorite trades to make, the buy the rumor, sell the news type of situation. And this looks fantastic. So that's a great one right there. Ozzy Ian, smash the like button. Lead services, I feel greedy this year so far. Dude, all you got to feel is feel out your trading plan. Like Frank would tell you, right? Over at Google, GOOGL, which I will forever call Google. It ain't going to be Alphabet. Just like Twitter will forever be known as Twitter. I'm not going to call it X. I'm going to say no. I'm going to X the X and call it Twitter. Google, you got your 10 over 20 or 10 under 20, price under 50, a very, very bearish area right here. Let's go to Goog real quick. Goog or Google, they're going to get you basically the same thing. Okay, if we zoom in over here, definitely want to point out the fact that the whole sector, the whole communication sector is getting more and more bearish, more and more fearful. Google itself actually peaked on the, you can't see that. Google itself actually peaked on the fear and greed map at R26. So a fear 26, 26 out of 50. So it goes 26 out of 50 on fear, 26 out of 50 on greed. This peaked at R26 and actually has come back just a little bit to R25. But right now, definitely is not one that I would be long. I would be looking for shorting opportunities if I were in Goog right now. Let's look at RBA short. RBA short. Actually, thank you for that. This was something I was thinking about. If you don't mind, because I can't tell where your head is at. If you are interested in, if you're putting your stocks in the chat, like Golden Oldie wants to look at Raytheon. If you put Raytheon in the chat, I'm always gonna look at Raytheon because I used to work there. Do me a favor, put like long RTX or short RTX, or even RTX short, RTX long, whatever. Just tell me if you're long or short. That helps me give you better analysis. So from this point forward, from today, this moment forward, say name of stock long, name of stock short. That's what I want to see. That helps me out a ton. But let's look at RBA for Ciao Italia over here. This one gapped up, and this is what we would call a gap and crap. How do we measure a gap and crap? So RBA looks like it had earnings and a huge move up. How big of a move up was that? Close to close, 8% move. Nice move right there. Now, gap and craps are measured by when it gaps up and then it starts closing under the low of the gap candle. That's a gap and crap to the downside. Let me show you a gap and crap to the upside. Where was it at? RSP? No, hang on. I saved one the other day and I was like, this is a perfect example. AT&T. Oh man, things are going slow over here. Okay, AT&T is a perfect gap and go example. As you can see, it gapped up. It never closed under the low of that candle, and then it continued on higher. That makes sense? So let's go back to, was it RSP? RBA. Close under the 10, that's an exit signal for me. I close under the 20, also an exit signal for me. So for me, this is a bail. So let's see. There we go. Thank you guys for putting the long and short. That makes it a lot easier for me. Golden Oli wants to look at the RTX long. So I've told you all this before, but I used to work at Raytheon. I had a secret level DoD clearance, and my projects were the Predator and Reaper drones, the missile targeting systems on the Predator and Reaper drones. If you ever look at them, there's a little nutsack looking thing underneath it. That's what I worked on. I worked in the finance department for that. But looking at RTX, you can see this big move up right here. It got more and more greedy, continues to get more greedy, interestingly. And the whole industrial sector getting more fearful. Interesting that it's getting more greedy, because RTX did have a big sell-off here, I guess after earnings, or probably something Trump related, it seems like. But he's looking at RTX long. I would wait, Golden Oldie, for two things. I would wait for one, the cross over this 10 moving average. Two, you've got this big order block right here that's really ugly. So it's going to have a lot of overhead resistance. So this could be one that I would personally skip. The man hog bear wants to look at NOC long. NOC Northrop Grumman. All right, so another defense sector. All right, got a buy signal just a couple days ago, it looks like. Yes. So it got decently greedy. I'm sorry, decently fearful down here around R34, 34 out of 50. And then you can see we got the buy signal come through as the fear starts evaporating, getting a buy signal and watching it go up. While the industrial sector is still struggling, Northrop Grumman is looking very strong and also losing the fear, moving towards the greed. That's what we're looking for. However, until we get these baked into Outlier, which will be really soon, I know Mahesh is working day and night to get the new charts into there, and we will have Outlier blocks on there. You'll see right here that it could have a bit of overhead resistance to get through, and then again, another double set of order blocks right above it. So Northrop Grumman is also one that is not the most beautiful in my opinion. A NASQ wants to look at Met long. Yeah, let's take a look at MetLife long. Ooh, ouch. An SQ. I would not be trading this guy. Let's go look over here as I eat my words with the buy signal, I'm sure. Yep. As I eat my words with the buy signal. But I would look at that more as a closing short signal. Right there. There's your short signal that came through as it started to turn down. And then right here, this would be a buy to close signal. That's the way that I would interpret that. But yeah, MetLife continues to look a little bit fearful, getting a little more fearful. The financial sector also getting more fearful. But yeah, dude, I know this is not a great one. I'm sorry. I wish I could give you some better news here, but MetLife to me looks more like a short opportunity than a long opportunity. Let's see. Alan wants to look at AV Go. AV Go. I almost feel like it's like a anime thing. AV Go. Pokemon Go. I don't know. Ooh, yikes. Look at this one. AV Go has a sell signal that just popped through here. January 6th, when it was around 236. Today, it's around 187. So nice sell signal right there. But look how greedy it was. That was 46 out of 50 on the greed. So not really surprising. I always want you to remember when you're looking at the fear and greed scale inside of Outlier, the further it gets, the more likely it is to snap back like a rubber band. And that's what we're looking at right here, is it absolutely snap back. And now it's getting deep into the fear category along with the whole tech sector. Both of those are looking quite fearful. So like I say, no trade setup for me today. Thank you so much for putting your stocks in the chat. But if you are an influencer of any size and any niche, we want to work with you. Send us an email over at support@outlier.com. I was just sending out some emails just a little bit before this. We want to make you some money. I hope that's okay. And I also want you to tell me in the chat what you're trading, and be sure to come back tomorrow, where outliers like us will save time, make money, and start winning with less risk together as a team. And of course, YouTube is going to pop up a couple recommended videos. I recommend you watch one of those. And I also recommend you have a fantastic day. And I'll see you on tomorrow morning's live stream. We'll talk soon.
10/20.